Welcome, everyone. Today, my guest is Kevin Peranio, Chief Lending Officer at PRMG, to talk about mortgage innovation and why he thinks 2024 is going to be an incredible year for mortgage lenders. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Melinda Wilner, Chief Operating Officer at UWM, about PA+. Melinda, why is it important for brokers to be scaling their business right now?
Yeah, well, one, it's a little bit quieter of a time, so there's more time to invest in making your process the absolute best one that really wows the borrower at the end of the day. But secondly, like we all know, rates are going to come down, and we need to be as efficient as possible to be able to scale for the future when we're all dealing with a whole bunch of refinances. So perfecting the process right now is a great move.
Great points, Melinda. And listeners, you can find out more at uwm.com. Kevin, welcome back to the podcast.
Thank you, Sarah. You know I love being on here with you.
I love having you on. I wanted to have you on specifically right now because this week you have been the keynote speaker for the Mortgage Innovators Conference. And I would love to pick your brain a little bit. We need some innovation and we need also some encouragement for mortgage folks out there. It's been a brutal year.
Yeah, we're pretty bullish heading into the conference next week in Anaheim, the Mortgage Innovator Conference. I was lucky enough to be asked on the California Mortgage Banker Association's board of directors, so I'm a new member. And Susan Milazzo is amazing. I mean, she's a CEO. She runs that thing. She's been there, a while, to say that. And they're a very good and well-run organization. I mean, they're financially sound. 25 to 29%, depending on what report you look at, of all originations come out of the state of California. So it's nice to have a strong state chapter. This is the last big tech show of the year, right? And before the summer break, right? And there's a couple in the fall, but we saw each other at ICE Experience, which is huge, and everyone kind of goes back to their corners, and it's summertime, right? And then you start to get prepared for seasonally slower time of the year. So I think this is everyone's last really good chance to get out and find out some things they can work on in the slower times, because you still have to innovate, you still have to build, you still have to make your platforms and your offerings stronger. And it's easier to do it when it's not as busy. And I don't know what you're saying, but we are having a great couple months. I mean, March, April, and May have been fantastic for us. We also saw June is going to be great. Locks are generally good. Second half of last year was brutal. We were talking about that the last time you and I did a podcast together, which I think you said was December. And, it was like you could only go up from here at that point, right? And so so for us, the bar was low. So we're feeling good. It's spring purchase season, and, every time a house gets completed or built, it's sold. So builders are loving it. There's probably still a little, too many originators out there in the business that are maybe not equipped to deal with a tough market, but the strong survive right now.
So really interesting to hear your perspective. I love that, because the headline on our podcast in December was why you were bullish on 2023. And here you are in 2023, continuing that theme and feeling like, it has been a good year. So what do you say, inventory is low, but apparently that's not, hampering you guys too much. What do you think about that?
Well, it's certainly a challenge, right? I mean, our business on the lending side is a capacity model, and we had too much capacity throughout the industry. And I think most companies, we certainly feel like, from an operational standpoint, we're right sized. We're in a good spot. I'll share some numbers with you. We funded $1.045 billion in loans, about 2,900 loans in the month of May. Now, we have 3 channels, so we're not just retail. We also have wholesale and correspondent, and we actually had pretty equal weighting amongst them. And our correspondent channel is even, has a little smattering of delegated offering in there. So about half that, third, a sixth of it, if you will, is delegated, and 6 is non-del. So we felt really good about our balanced product mix. And so if we come down to, say, 600, all right, no overtime, maybe we go back to a 32-hour work week. But if we go up over that billion, then, we can maybe flex to offshore, maybe offer more overtime. So we feel like that's a nice sweet spot to be in as a company as we wait for the next big leg up, which would come with a Fed cut likely next year in an election year. If we're in a recession, or the rates are so high that they don't need to be as high as they need to be, for the market. So, but that's not to say we don't have challenges. I mean, lack of housing supply is a challenge for everyone. And I think that's where the spotlight now is. There's too many originators chasing, too few homes for sale. And, you've got a lot of originators that built their teams to scale, but the housing supply isn't scaled. Builders can only do so much. They're on pace for like 640,000 units a year. And every time they, put one up, it's sold, right? And whether you want to call it, no matter what you want to call the phenomenon, existing home sellers, are not selling as much. And, a lot of it has to do with they just bought at historically low rates. Maybe the reason to move hasn't shown itself yet. Plus, they're in lower interest rates. We kind of think around the 5.5% Freddie Mac average rate that someone would forego their 3.25 to have a bigger home. It's plus the equity that they have gained along the way kind of offsets where that payment would be. And so yeah, supply is a challenge for everybody. It's a challenge for realtors, everybody. So it's not that we're not without challenges. It's just, it's just the worst of it was last year. I think September was the low month, and November was the peak in rates. And we've just seen business and rates improve generally since then. And I will say, even if rates kind of recently spiked up with the whole debt ceiling debacle, they kind of got back into that 7% range. It's not as volatile and downtrending and sustained as it was from February of 22 all the way through November of 22. It's like bars are like, okay, like we're in this range between, 6 and 7, 7.5 to, 5.75, whatever. Like that's the range. That's the going price. The timing of when I need a roof over my head, isn't going to give me a 4% rate. I need a roof over my head. I got to make the move. And so the lack of volatility in interest rates and the fact that it's not a severe downtrend like it was in 2022, I think bodes well. And perhaps the second half of this year, even though seasonally slower for purchase business, I think could surprise people. I think, people got to move, right? So they're still going to move if housing supply comes up, and who knows, maybe we get a little tailwind and we get the Fed to pause and then maybe at some point cut rates and then we get even lower rates. So we're positive, we're bullish, we're grinding. It's not without challenges, but nobody wants to sit next to someone in a foxhole fighting when they're complaining and whining all the time. You got to fight. You got to fight through it.
Kevin, that's so true. I think we might actually see a better fall than people are expecting for all the reasons that you just said. I did want to ask you before we move on too much, when you talked about how you guys feel like you're right-sized, what does that look like as far as the mix of people that you have, underwriters versus, loan officers versus, what you might do offshore? Tell me a little bit about that.
Sure. Every company's different, right? And so we do a lot of government lending. About half of our business in May was government. And so we're a community lender. We've got 200 retail branches in communities. We're a Ginnie Mae issuer. So, we're able to do, tough deals, serve the underserved. And we have the HUD Watch numbers to prove it. So, there's a little bit more intensity in underwriting. There's a little bit more manual work. And so we feel good about that. Then you've got your cookie cutter stuff that comes around. And, we've always had an offshore resource that we use, and it goes back to a relationship that so there's 4 partners at our company. Paul and Robert founded the company, and then I've been with the company. October will be 13 years as a partner, a little over 7, and then Gary Malice is our partner over strategy and capital markets. He was one of the owners of First Magnus, which is where I started in the business in 2001, and he and that team at First Magnus created an offshore group. And we've been using them for many, many years. And but we're not an offshore company, right? So, they do some work on, some processes, whether it's lock validations, maybe some help in post-closing shipping. From an underwriting perspective, they are helping with certain file types. But it comes back to an onshore resource that cleans up the file, and all the communication and customer-facing communication is all onshore. So we're not like a huge offshore company, but it helps us keep our cost to underwrite. I mean, we can underwrite a file for $50 offshore, and then another $25 for the onshore resource. That's $75 to underwrite a file. So we think that helps us kind of stay in the game. So that's how we use it. And again, when you say right size, I mean, I think it's harder to be bigger right now. Imagine if we did $2 billion in the month of May, and then in the month of September coming up, we only did 1.2 billion, right? That's the equivalent of maybe going from $1 billion to 600, right? So 800 million in monthly business lost. It's hard to be like, all right, no overtime, we're going to go to short work weeks. I mean, you're overstaffed. And so bigger companies have a tougher time in slower markets. So I'm just speaking for us as far as like our size and our volume, where we feel good about where we're at. But we don't, we've never wanted to be number one and hire thousands of people, and then you got to fire thousands of people, and that's not a shot at any lender, but that's just, economics. I mean, when you get big, it's hard to manage. Look at the lenders that have gone out of business. There's just 5 wholesale lenders in front of our wholesale channel that don't even exist anymore. I don't need to name names, but you truly, there's no too big to fail in our business unless you're a bank, of course. But you get big in our business, you can get on the out of bounds side, and so we feel really good. We're being patient. When it gets slower, you gotta develop your team. You gotta work on resources. You gotta try and be more efficient. You can't just cut your operation costs and that's it. Like, you got to make that cost that you spend more efficient, and do more units. And that comes with trying to, build and develop, deflationary technology. And so that's a lot of our focus in both ops and sales.
Okay, well, let's talk about technology. One of the biggest things that, everywhere I go, people want to know about AI in a different way than AI, say, 3 years ago, 2 years ago, because there have been a lot of, things happen, ChatGPT, other things. What do you think is really innovative right now? When you're going to be speaking at the Innovators Conference, what technology do you feel like is making a difference right now?
Well, this is my third podcast taping in 24 hours, and AI and data are all the rage, right? It's interesting, like ChatGPT came on board, and now like AI is mainstream, and the reality is there's no I in AI. It's not sentient. It's not going to take over the world and be Skynet and shoot us all and steal our pets, right, and cause a nuclear holocaust. It's still, rules based and algorithm based, and again, ChatGPT is a large language model, not to be confused with other kinds of AI. I'll give you an example. So in our business, there's all these little processes that are kind of manual and wonky, and we've been using robotic process automation for several years, and we have a team that does that. We have, some developers and engineers and stuff, and I think every company, kind of goes down that path. The software we use is called guided UiPath. So UiPath is the software we use, and then we try and come up with different ways to just be more efficient. Whether it's pinging a HUD website to try and clear cavers or pull up a case number, or just a software bot that's programmed to do something. And then and so where I like where ChatGPT is going is it's created this big buzz, and now AI is like a mainstream. It's so funny. Like, as soon as that came up, there are companies that have been in our business for like 10 years, and all of a sudden, like, their slogan is like AI. Like, they just started using the word AI in their slogan. I'm like, no, you're the same thing you were yesterday. Like, but anyway, I'm not going to call them out. But it is a buzzword right now, and the bottom line is, like, using technology is deflationary. It reduces friction, it compresses time, and it allows you to scale your business. And that's important in both sales and operations.
No, that's great. I love that. And I like your idea of like, AI is now mainstream. That's exactly what I was trying to get at. Is like, it's not like it hasn't, RPA's been around forever, other parts of this, but now everybody kind of gets it, or at least they have access to it in a different way. And I do think it's gone mainstream.
Yeah, 100%. And that's good. If maybe some small emerging mortgage bankers are talking about like, well, how, I've got this company that does, 50 million a month, 100 million a month. How can I use AI to build my platform? And they may be the next big lender, right? Because they're small enough to kind of tinker and ingest things like that into their operations and then leverage it to become big. And so it's great for all of us. It is mainstream, and everything's data driven, right? Like your AI is only as good as your data allows it to be. So where are we getting our data? I mean, do we have 100% compliance of day one certainty and tapping into access of bank accounts and income and IRS? I'm working with this great company, Halcyon. They have an API with the IRS. Like literally, like I don't have to pull a 4506. I can just get a bar opt in and ping, 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 and then I can get 5 years of look back data and 5 years forward. So it's also kind of a lead gen thing. And so that's not AI, but that's a more efficient way for me to get data directly from the IRS quicker. And then I can take that data and do other stuff with it, run it through my automated engine. I can get findings faster. I can validate income faster. I can bug my borrower less. I can, have my underwriters trust that the self-driving, findings will actually get you from point A to B, and so, there's a lot of those little battles that are fought every day to try and, implement new technology into all of our workflows. I think day one certainty is like a perfect example. I said it for a reason. I'm about to get on a little rant here, so forgive me. Rocket Mortgage was given day one certainty first before everybody, which was push button get mortgage. And just for our listeners that want to know what that is, thank God Fannie Mae and Freddie Mac, with the blessing of FHFA, their regulator, allowed access and opened up this whole industry for push button get mortgage to happen. So borrowers give us their usernames and passwords for their bank accounts and their employers and all this different stuff. And we're grabbing income and asset information straight from the source and calculating income and assets. So Fannie Mae and Freddie Mac are blessing the findings and going, hey, we'll give you rep and warrant relief because they are getting access to see straight from the source of data, income and assets. And so it's like pre-funding quality control for Fannie and Freddie. The problem is assets aren't being used fully because originators are scared that when that gets pulled, that there's a guideline that would get blown out. I'll give you an example. And I've had discussions with Fannie, Freddie, and FHFA about this. If there's a large deposit on bank statements that get uncovered through pressing an automated button in day one certainty, that deal's dead, right? Maybe, I don't know. The current guideline says source all deposits. So now you gotta go find out where it's from. I don't know where it's from. We don't know where it's from. Maybe it's from a family member. Maybe it's a gift. Maybe it's not. I don't really know. And so that unknown of what's going to be uncovered, originators throughout the entire industry don't want to put that in front of an underwriter. They sure as heck don't want to put that in front of day one certainty, where Fannie and Freddie are looking at it because it just got ran from an automated version. The guidelines allow you to have 60-day seasoned funds. So now instead of using day one certainty, because the guideline scares everybody of the worst possible outcome. I'm not saying all the outcomes of large deposits are bad, but there are some outcomes where they are bad. And so originators are like, I'll just wait 60 days and then I'll show them the bank statement where there's no large deposits and all the funds are seasoned. And it's just for down payment anyway, right? So if it doesn't show up on a credit report after those 60 days, is it really a liability that you care about? So there's all these deposits that I don't know where the money comes from, and it's just kind of a pain to have to source. If it doesn't show up on the credit report as a liability, it's not really a debt to income risk to anyone. But it's being used one time for the down payment. So does it really matter? Like, does it really, really, really matter, right? Unless it shows up on a credit report. So I think they need to change their guideline and allow, maybe change their guideline on how they look at gifts, how they look at large deposits, and they would get a lot more usage of day one certainty on the asset side, which would compress time a ton on getting loans put through the process. That's just one that is not being used at wide scale, and I think it's a huge missed opportunity that Fannie Freddie and FHFA could do something about.
So I think it's really interesting. I was talking to someone at FHFA last week, and they were talking about it, how they're like, there are all these things out there. How do we get lenders to use them? Right? It's the adoption. I mean, there are more things out there and probably in everybody's tech stack than they actually use.
Yeah, no, I agree. I was invited to take part in a panel and discussion at the FHFA coming up in July. And it's basically like a showcase of new technology. They have I gotta tell you, Jason Cave, for example, might be who you talk to. He's the head of innovation at FHFA, making a real public push, trying to get out there in the market, talk about technology, and how to get the GSEs aligned to look at certain things and approve certain things that make sense to help serve more borrowers, get more borrowers. Get their taxes prepped more readily for less expensive, get more access to information, show more rental income history because some people are credit invisible. There is a lot of stuff out there. And to be honest, it's overwhelming, right? Because, our business is so originator centric. I mean, our company, our motto is built by originators for originators, our two founders. And so we serve originators no matter how they want to be served. So originators only have so much time. They're grinding for deals right now because there's a lack of supply. So maybe now's not the day that they're going to go use like this new QR code, WISP to go out and extract cell phone numbers off all of their marketing collateral. Like they're just, trying to like grind through deals and answer, phone calls and make phone calls. And so, and then the flip side is when it gets busy again, it's hard for people to, all right, well, I'm so busy. Loans are falling out of the sky because rates are low. It's hard to go do something new. And that's just our business. It's a very manual, rugged, hand-to-hand combat business. And it's always hard to, I've always said this. I say this all the way. It's like my phrase. It's hard to zoom out and just kind of look around and then be able to go, okay, here's the big picture. I need to do this, this, and this. And so, I've used that phrase zoom out for ever since Zoom was created. So
I appreciate you using that. I have a question. We saw in 2020, 2021, lots of lenders go public or try to go public. PRMG, you guys are privately held. Why do you think that is an advantage to you right now?
Yeah, I think it's an advantage all the time. Again, Paul and Robert founded the company. Maybe they're partners 7 years ago after working here about 6. And that's why I moved from Fort Lauderdale to California. And I had been an owner of a company prior for about 3 years. So I know what they go through. And there's some challenges. I remember after '08, and there's our partner, Gary Malice, who was one of the owners of First Magnus, brilliant mind, great dude. So there's a strength in numbers, there's a team approach. You get to bounce things off each other and share the risk, share the capital requirements and all that. And I think you can build to scale higher when you have a stacked bench. But I remember after '08 in the Great Recession, everyone wanted to hide out at the strength of the banks, right? Because it was great to be at a bank. Brokers got crushed, all the regulation crushed them, and the balance sheet of the banks was the place to be. Now remember, those balance sheets were only there because the Department of Treasury bailed them out, okay? So there was no strength. There was no capital anywhere at that time, and it was brutal. And so that was kind of the place to be. But banks are banks, they have their purpose. They do different things. Independent mortgage bankers, all we do is mortgage. It's our only line of business. That's all we do. We're built by originators for originators. That is it. Not trying to open a real estate company. We don't have deposits, checking accounts. Got to worry about our treasuries running off and deposits running off. Like banks got other problems to deal with. You think they want to deal with the crap we're dealing with in mortgage and real estate? I don't know, man. So I worry about some of their appetites in a time like this. You lose money for a year at a bank. I mean, maybe they're like, we're out. I mean, look at some of them that pulled out of jumbo even, And so what's interesting is last year banks were strong again. But then this banking crisis happened in March, and now banks are like, okay, maybe I don't need to make a bunch of jumbo loans out there to third parties. I'll just take care of my retail clients, my deposit clients. So banks aren't even where it's at right now. And so we're here, we're in the community, we're doing the tough loans, we haven't gone anywhere, we've got resolve. There's only 4 of us. How much money do you have to make, to make it through? And 20 and 2021 were great for every independent mortgage bank, for everybody in this business, for that matter. And so there's something to be said about the flexibility. And it's not like there's a lack of oversight. I mean, yeah, banks are regulated, but we got the CFPB. I mean, we've got fair lending exams that we go through and work together with our partners at the CFPB. We have audits with Fannie and Freddie and Ginnie all the time, all of our warehouse lenders, every single state. So it's not like, it used to be like, oh, be independent, you're not regulated like a bank. I mean, we're regulated like every which way from Sunday. So, that's the business right now. So I would not want to be starting a wholesale lender from scratch right now. I think the bar is so high. The barrier to entry is so high. I think all the incumbents, all of us are left, have built such a machine to lose money at scale for an extended period of time to wait for the market to come back around. I don't know why anyone would want to start a wholesale business. So you see a lot of people, coming out and doing non-QM because, you can make a little bit more per loan. I mean, it's the new subprime, right? I mean, it's not subprime because the bars, they do perform well. The guidelines aren't like 80-20, no doc, 100% financing, but the margins are fatter there. So you see a lot of companies pivoting to non-QM or coming out at non-QM because they can't make it in A paper. There's a thinning of the herd right now in A paper, and there's still some consolidation that's gone on. And I think that as the incumbents and those of us that are left, I mean, we've never thought of us as like we're a big guy, like we're your community lender. Like our CEO and founder is on the phone every day with our employees just working through stuff. Our COO is he's working on deals individually and underwriting that need a business decision. So, even at $1 billion a month at our peak, $1.75 billion, we're still a community lender and we're very involved. And I think there's some advantages to that. I think it's very hard to jump in the game right now in certain spaces for sure. Independent is with a strong balance sheet. I think it's very important right now.
Well, I also think, it's one thing to say, yeah, we're going to start doing non-QM, but you have to have the bench strength of people who know how to do that right.
100%. I mean, we've hired some great people at our company to run that. Paul Jones is out there. He's a gentleman I have a ton of respect for. I've been on panels with him in the past. And when First Guarantee went out of business, another company that, got sideways for whatever reason, their money was with a hedge fund backed fund out of PIMCO and they pulled the plug, and it's unfortunate, and so we try to bring on good talent from that team and help out where we could. And we were already doing non-QM and we were banking non-QM. So we have 4 different relationships where we underwrite in-house and close and fund and sell off close loan packages of non-QM deals. We don't just broker out non-QM deals, which we also offer that too. And Paul, we brought on to help be our non-QM expert. He holds trainings. He helps with our cap markets team with Gary Malice and then our underwriters. And so, but that's 10% of our book, could be 15 if we flex up. Rates come down, A paper is where it's at. I mean, A paper is still going to run, right? So we find balance. We're diversified, but we're not going heavy in one direction. I mean, look at, March of 2020 when there was a liquidity event. What was the first thing to dry up? Boom, non-QM, gone, done. Like it just froze overnight. The whole reason the word non-QM is there is because it's a non-qualified mortgage as opposed to defined as a qualified mortgage per Dodd-Frank, which is an A paper GSE loan. Non-QM has its own separate private market. And we could have another pandemic tomorrow. I mean, God forbid that doesn't happen. It sounds awful, but that absolutely could happen. Okay. And if that happened, we're already in a liquidity drawdown with the Fed doing what they're doing. What do you think's the first thing to dry up overnight? Non-QM. Immediately. And so if your whole business model is just that, that's tough, right? And God bless those people who have, the chutzpah to get out there and do that. But it is, Dodd-Frank carved that out to protect the A paper world. And so, second liens are under pressure. If we have a serious job loss recession and defaults go up, which they have not, but if they do, what's the first thing to go? Second lien. So it's same as it ever was. This business is about, quality investments and being sound financially and being diversified. We're diversified within mortgage banking, we feel. And so but having said all that, I if I could maybe prognosticate on on where the industry is going in the next 12 months. I think next year is going to be huge. I think next year will be the fourth biggest year on record. And the reason I say that is, just think about this. So the last 12 months, you have first-time home buyers. Okay, it's actually a little more than 12 months at this point that have been at higher rates. Okay, and then you're going to have about let's call it another 12 months under your belt. Spring Q2 of next year. You get 24 months. Okay, 1.5, 1.3, 1.5, 1.5. Let's just call it $3 trillion in first-time home buyers or purchase business at higher rates, at larger loan amounts, by the way. I mean, the loan amounts are larger than ever. Like, there's no supply. The loan amounts are huge. So for there to be a net tangible benefit for a borrower in a year from now, they could probably just go down 75 basis points in rate, 0.75 in rate. If the Fed pauses, okay, we might get that rate decrease. Or maybe we don't. Maybe it's higher for longer, and the Fed cuts sometime next year. And then you get that. So now you've got cheaper money getting some of those 3% borrowers' existing home sales off the shelf to buy up. Okay, so you got some more inventory come on. Plus you got about $3 trillion of borrowers that want to refinance. And our business has been shrinking since the $4.6 trillion 2020 and 4.3 or 4.1 2021, whatever you want to call it. So the capacity is down. So it will feel even bigger. If the number is the fourth biggest year ever next year, it could feel like one of the best, like a top three. So anyway, we're extremely bullish, even more so on next year, based on the way the setup is there. And who knows? Maybe a couple more big players decide to drop out of this business. That, like you said, at the beginning, some people you talk to, it's brutal. They don't have their P's and Q's in order, and people do funny stuff when you lose money for a year straight. They're like, yeah, why are we in this business? And you'll start to have some of those conversations happening if they aren't already. We're good. We think a lot of independent mortgage bankers are probably in a good spot at this point. They've survived this far. We'll see what happens the second half of the year. But I still think next year is going to be a great year.
Well, I'm going to end on that very positive note. I agree with you. And I also think you just have all the people who for the last couple of years have been shut out of homeownership for different reasons. And there is going to be some pent-up demand if we get some of those rates a little bit lower. And even if you just think about, some of the natural things that happen, even for those 3% borrowers, a couple of years down the road, things change, things happen. So I'm all on board with you, Kevin. Love your enthusiasm. And thanks so much for being on.
Of course. Thanks for having me. Anytime you ask, I'm like, yes, ma'am. You tell me when.
I appreciate that. And of course, our listeners, you might have be hearing Kevin at the Mortgage Innovators Conference. He's their keynote. I'm actually also going to be moderating a panel, which I'm pretty excited about, on mortgage innovation, cool. A VIP mortgage innovation roundtable, and Jason Kay from the FHFA will be on that. So I'm really excited about that event. Yeah. It's funny. That's who I was talking to when he was talking about, like, how do we get people to, to adopt what's already there or to start using it. So Kevin, great conversation. Love having you on, and I'll see you soon.